Imagine a financial structure so perfect it seems impossible. A company that provides the capital for its customers to buy its own products. This week, the veil has been lifted on what analysts are calling the AI Ouroboros. Leaked data suggests a circular flow of billions, where Nvidia and other Tier 1 AI giants are participating in massive funding rounds for the very cloud providers who are their primary revenue sources. We are witnessing the birth of a closed-loop economy that looks less like organic growth and more like a high-stakes shell game. But as the liquidity spins faster, the question isn't just if it will stop. It's what happens to your portfolio when the gear finally jams.
Recent filings and internal leaks have exposed the mechanism. Major semiconductor firms are not just vendors. They are becoming venture capitalists for GPU-rich startups. These startups take the investment capital and immediately return it to the vendor in exchange for H100 and B200 clusters. On paper, this appears as record-breaking revenue and exponential growth. In reality, it is a balance sheet expansion that bypasses traditional market demand. This circularity creates a revenue mirage that has propelled the S&P 500 to historic highs, but the foundation is built on recycled capital rather than end-user profitability. This round-tripping isn't just a technicality, it's a systemic risk. When a cloud provider uses debt or venture equity to buy hardware, they must eventually generate a return on that hardware. However, current data suggests that the last mile of AI, the actual software being sold to businesses, is generating only a fraction of the revenue needed to sustain the hardware capex. We are building the most expensive digital bridge in history before we know if anyone is on the other side. If the software revenue fails to materialize, the entire circular flow collapses into a debt spiral.
The core of the bull case has always been the scaling laws, the idea that more data and more compute will lead to linear improvements in intelligence. But the physics of computation is hitting a wall. Recent National Bureau of Economic Research studies indicate a terrifying trend: diminishing returns. We are entering an era where model improvements are becoming 5x more expensive to achieve only a 2x increase in performance. The cost-to-output ratio is diverging, meaning the next generation of AI may be economically unviable for most commercial applications. To move from a GPT-4 level of intelligence to GPT-5, the estimated compute requirement isn't just double, it's orders of magnitude larger. We are moving from training runs that cost $100 million to those costing $10 billion, and soon $100 billion. At these price points, even big tech's massive cash reserves are strained. If the intelligence gain from a $10 billion model is only marginally better than a $1 billion model, the economic justification for the GPU land grab vanishes overnight. This is the efficiency wall that the market is currently ignoring.
Beyond compute costs, we are facing data exhaustion. The high-quality human-generated text that fueled the initial AI boom is a finite resource. Recent studies show we have already scraped the vast majority of the high-quality internet. Training on AI-generated data, the so-called model collapse, leads to degradation. This means the 5x cost increase isn't just for hardware. It's for the increasingly rare, clean data sets required to prevent the models from hallucinating. The fuel for this revolution is running out, just as the engines are getting more expensive to build.
To understand the present, we must look at the dot-com burst. In 1999, Cisco was the Nvidia of the internet, providing the routers and switches for the digital revolution. Their stocks surged because every company needed their hardware to exist online. But a fatal disconnect occurred. The infrastructure build-out happened 10 years before the actual profitable use cases, like streaming and cloud software, matured. When the telecom startups ran out of venture capital, Cisco's orders didn't just slow down, they stopped. The resulting crash wiped out trillions. We are currently seeing the same warning signs: massive overcapacity. Big tech is spending over $200 billion annually on AI capex, but corporate IT budgets for AI implementation are only growing at 5–10%. This capex cliff occurs when the infrastructure providers realize their customers aren't making enough money to pay for the next upgrade.
If Microsoft or Google cuts their GPU orders by even 15%, the valuation of the entire semiconductor supply chain, which is priced for perfection, will face a violent re-rating. The crash trigger won't be a single event, but a sequence of earnings misses. Keep a close eye on the Days Sales of Inventory, DSI, for semiconductor firms. When inventory begins to pile up while lead times shorten, it indicates that the circular flow is breaking. If secondary market prices for H100 GPUs begin to drop, which recent data suggests is starting, it means the scarcity premium is dead. For an intermediate investor, these are the early warning sirens that the AI supercycle is shifting from a build phase to a bust phase. If the leading AI enterprises, which currently account for 80% of S&P 500 gains, experience a 20% correction, index investors will be hardest. Protecting your capital requires a pivot toward deflation-proof assets. During tech-led corrections, capital often flees toward high-quality treasury bonds and value sectors that have been neglected during the AI craze. We are looking at companies with high free cash flow yields and low debt-to-equity ratios, firms that don't rely on the circular flow of venture capital to survive.
Look at the real economy. Utilities, healthcare, and consumer staples are trading at historical discounts relative to tech. These are the assets that perform when the growth at any cost narrative fails. Additionally, holding a cash position isn't just waiting, it's an option on future volatility. If the AI bubble bursts, the opportunity to buy high-quality software firms at 2002-style valuations will be the greatest wealth-building event of the decade. Strategy over hype. AI is not a fad. It is a transformative technology. But like the internet before it, the first wave of investment is often a sacrificial one. The circular investment trap will eventually clear, leaving behind a more mature, efficient, and profitable industry. The winners won't be those who bought the peak of the hardware hype, but those who remained liquid enough to buy the utility. The question you must ask yourself tonight is your portfolio built on actual profit, or is it just caught in the circle? Stay disciplined.